Certainly, global economic activity has slowed, a fair amount this year. You see it in China, you see it to a lesser degree in Europe, and in the U.S. Of course we're not seeing that because we're still in the afterglow of all this economic stimulus that we're getting. But the consensus is that there'll be some slowing next year. You see it in the earnings numbers, probably going from 24% in calendar 2018 to maybe 9 or 10% in 2019. Still good numbers. So the demand side for oil has been robust, but there's clearly some slowing, and then you have some short-term concerns about supply, and we're hearing all the news about OPEC. So oil's down about 20%, but commodities in general are down, and I do think China plays a large role. It's one of the key components that we try to figure out in terms of this puzzle for next year. We know we're in this holding pattern in the U.S. market this year, but next year a few things have to come together. Earnings in the U.S. have to slow, but not much beyond 10%. You've got a decent valuation already on the S&P, but China needs to figure out some way to reflate its economy. And China has been slow, and the yuan is sort of teetering at 7%. And so that's something that we don't really quite know how it's going to resolve itself. And of course, the Fed plays a role in that. It's driving up the dollar, it's driving up liquidity conditions. And so oil is a little bit in the crosshairs of that. But certainly, we have to take the moves with a little bit of a grain of salt because commodities are a highly volatile asset class. So a 20% decline in oil is not the same as a 20% decline in the S&P 500, for instance.
Well, we just got, when we were back above 80, we were starting to hear rumblings of $100, and even, we heard the super spike term again used. How did it, I mean, no one expected 85 to 60 and just overnight. So I don't know, is it, Talley, is that in your calculus for oil? I know you don't follow that, but it must say something about other markets, I would think.
Well, I think it's some of everything that we've discussed. A bit of a cooling in global growth, that's the demand side, but there's a supply side as well, and that's the record production we're seeing here at home in the U.S. But I think there's also a silver lining, to the extent that the strength of the dollar has been tightening financial conditions in the U.S., the flip side of that is the decline in oil, which I help kind of take.
We're never happy.
Some of that back.
Now we're worried. Oil, S&P, oil. A lot of oil components in the S&P. But it's a tax cut again, right? I mean, much better for the economy than 85.
Right, and insofar as October and the sell-off in stocks was simply a repricing of risk, that's what I think it was, as opposed to an imminent collapse in the economy. I think this is potentially a buying opportunity for investors here through the end of the year.
You, you're an international investor at Oppenheimer as well, right?
Correct.
So where's the value here? You like emerging markets now? It's been tough, right, for 6 months? It
has. It's been a brutal 6-month period. But look, when I think about this year and the outlook for next, I think it's really about the divergence-convergence trade between the U.S. and China.
Wait a second, you mean divergence? We've been talking about that, how the trade no longer makes sense, but convergence meaning we're coming back to it?
It's a big discussion at the cocktail party where I was. It was weird. Everybody, just little pockets of people talking about the divergence-convergence trade. No, not really.
Well, to clarify, so as Becky alluded to, this year has been all about, at least through September, the leadership of U.S. equities helped by significant fiscal stimulus, but I think that changes heading into next year. So we have the kind of fading tailwinds of that coupled with tightening monetary policy here at home.
We can't outrun the rest of the globe.
Correct. I mean, we were talking about slowing earlier. I think we're facing that to a degree here in the U.S. Meanwhile, in China, they're doing the exact opposite. They're doing about face on the fiscal and monetary sides. So they're actually implementing tax cuts for businesses and consumers in January. So I think a lot of what happened in the U.S. this year will happen for China next year.
So maybe the only bright spot in that entire scenario, if that's how it plays out, is that the dollar won't be quite as strong.
Yeah, and I think that really helps give China and the emerging markets more broadly a bit of a boost.
Hey, Jurrien, are we still waiting for every comment or body language from President Xi and the relationship with President Trump? I mean, you saw what happened with Macron. We can, the headline is, oh my God, he really just embarrassed Trump. Next thing you know, he's got his hand on his knee like they're best friend. I mean, the same thing with China. We don't know, right? There could be something positive perhaps in the next couple of weeks with China, or you don't think so? 20-year Cold War.
You know, certainly the hopes are there that there will be a thaw, or a truce, if you will, in terms of these trade tensions between the U.S. and China. You know, my sense is that if this indeed is a long-term containment strategy on the part of the U.S., then I would probably fade any kumbaya moments, if you will, on trade, because I think this is a longer-term process. But you know, who knows? I mean, China, you know, China's stock market's down 30% from its highs, and the economy is slowing. China is having trouble easing because they are stuck with what we call the impossible trinity, which is that you can't have a free flow of capital, you know, a stable currency, and independent monetary policy when your currency is tied to the U.S. dollar. And the U.S. is tightening, China is easing, and that easing is not creating a very large multiplier because they're kind of, you know, in the crosshairs of tightening liquidity conditions, a rising dollar. You know, as we're just talking about this convergence, I do think that's potentially a story for 2019, but we need to see a number of things happen, and trade remains a stagflationary headwind, if you will. I don't think it's a global trade war. You know, Canada and Mexico have been sort of resolved. So I think at the margin, it's a headwind. It's one that will keep the PE in the U.S. lower than it otherwise would, because either these tariffs will cause higher prices for consumers or lower profit margins for companies. Right. Either way, it's a form of stagflation, which justifies a lower PE than we would otherwise see. So I think it's a long-term headwind that is not going away anytime soon. But it's also not binary. It doesn't mean the economy here is going to go from expansion to recession. It's just, it's a headwind. Okay.